All right. Well, I will say hello to everybody, panelists and everybody attending the session. I don't know on this, is there any way to see if anyone attended? Oh yeah, there's a. So welcome everybody. And we're here today talking about investing in impact for health, impact investing in health. And having a panel discussion and a general discussion on what has worked, what hasn't in everybody's view, and how one measures success. And so I will just start by, first of all, introducing myself and the panelists, and then just a couple of introductory words, and then we'll I'll let the panelists introduce themselves, actually. So I'll start. I'm James McIntyre Brown, commonly known as Mac. I'm currently Health Practice Director at DAI Global Health in Europe. And I've had about 25 years working in health systems, particularly in market systems for health, private sector innovations, social marketing, social behavioral change, and public-private partnership. And that's me. And now I think possibly the best way is to go one by one with our great panelists. So possibly we'll go in list of on the paper. We'll start with Prabhu. Perhaps you introduce yourselves in a couple of sentences.
Sure. Hi, I'm Prabhu Tirupati. I'm principal with COIS. We are an impact finance firm. Sorry for the video. Yeah. So I'm principal with COIS in our Mumbai office. We are an impact finance firm and have investments across India, Europe, and the US in the area of healthcare as well as other areas of impact.
Great. And then next we'll come to Noemi.
Hi there. My video seemed okay. There we go. So the host has let me in. Good morning, good afternoon, or good evening, everyone. My name is Noemi Denau Schroeder. I'm a senior investment advisor on the USAID Invest project. The Invest project is a global effort, and the focus is on mobilizing investment, equity, debt, that contributes to USAID development objectives. It's part of USAID's broader approach of private sector engagement. We are project-based in DC, but we have a presence now with activities in about 62 countries and cut across 14 sectors, including health.
Great. And next, let's come to Mark, please.
Great. Hello, everybody. Mark Allen. I am the Director of Global Programs and Strategic Partnerships for Merck from Others, also known as MSD from Others outside of the US and Canada. I have responsibilities for our programming that happens outside of the US, as well as other partnerships which are leaning increasingly more toward a lot of innovative financing partnerships, which I will provide a bit more context and color today.
Great. And Victoria.
Sorry, for some reason my video is not working. I'll fix it before we carry on.
Okay.
I think I can't. Sorry. Here we go. Is that working now?
Yeah, it is. It is.
Brilliant. Yes, so Victoria Goodfellow, I lead the healthcare financing business at Lion's Head. Lion's Head is a specialised investment bank, which really started with a focus on sub-Saharan Africa, although our geographic footprint is expanding. We cover a number of sectors. I mean, our specialism is development finance, and healthcare is really a key pillar of that. We've worked both on the asset management side in healthcare, and also more on the advisory side, looking at innovative finance mechanisms, fund structuring across a range of topics, but especially with a lot of expertise around financing global health commodities.
Great, great. So I don't think I've forgotten anyone on our panel. Have I? Good. So I think probably what we ought to do is just move straight to the topic number one. And then maybe if I introduce what I was planning to do is introduce what we're thinking about and what we're wondering about, would be a good way to start. So basically, I think, what is the exam question here? What is working in impact investing in health? And to me, the first question is, well, how does one know? How do you measure that? One of the things we're looking at today. And I mean, I hope that probably, we would all be on the same page that is the investment, so-called impact investing, and we'll examine what that means. Whatever those initiatives that fall under that very broad range of possibilities, what that means, what we're looking at is, I guess, does it deliver towards sustainable development goals? Does it reach the base of the pyramid? Does it address equity? Do the innovations or the interventions that are invested in, do they deliver against development goals? And so I think, that's how we frame the question. And then it brings me to another sort of question to pose, is that when this topic, and the topic of impact investment in development and in health and development is, features a lot, but it does cover a very broad range of themes. And so I think, language is important, and what we're actually talking about to be very clear is important. As far as I'm concerned, it covers, why the interest over the last 20 years or so has grown in momentum, is very much around the desire to look for alternative sources of funding for to help achieve social development goals beyond the public sector purse and development partner support where appropriate. So that sort of seems to be what's behind, and then that seems to play out in a range of mechanisms represented by, my colleagues on the panel here today, different sorts of initiatives, but it can cover a broad range of things. And it can be the large corporate sector pursuing business models and lines of business which have a social impact. It can include donor-funded or donor mechanisms like our INVEST program, which are to find ways of channeling public investment, public-funded ODA money into supporting initiatives, to supporting startups, to supporting business growth, which deliver a social return. It can be a range of other donor-funded mechanisms supporting innovation as well. But also, it tends to cover a broad church of different, public-private partnership, different contracting models. So there seems to be a common theme of there's a sort of the private sector is involved somehow, but it's not just all about the investment or the source of money. It seems to be an element of who delivers as well, and different models of engagement. And then we ask questions about, is it public engagement of the private sector? There's a term in development, private sector engagement, which is bandied around, which is an actual theme that programs are named, in that bucket. There's a whole departments and development partners for it. To me, it seems, I suppose, rather old-fashioned in that there's a development partner, and then or there's a public sector, and they're the ones who are going to engage as a third party with the private sector to deliver services or goods or public good. A lot of engagement in impact investing is private to private, after all. It's private funds investing in private innovations for a public good. And it shouldn't rule out the possibility of public investment. I've come across sovereign wealth funds in various countries who look for sources of investment, sometimes back in their public sector for innovation. And then, so with that, I think we just narrowed down to sum up that what we're looking at is the range of raising funds that aren't in the run-of-the-mill public sector purse and different delivery models. So it's investment models and delivery models and how that works. And that's what we're looking at. And then in summary, we are defining working, and we're going to look at today what we think. Does it work? Does it do what it says on the tin? That's the issue we're going to look at. So what we planned for this first session here, this is the what's working as what is not, is that our panelists from the range of sectors or range of subsectors in that each one is working in will give some examples of how they believe it can be measured and demonstrated what they are engaging in works and what are some of the challenges. And then we'll go into our second topic, and then we'll have a question and answer session at the end, a discussion. So I think possibly, why don't we start with you, Victoria? And I'm conscious of time, so if in 5 minutes each, you could give us some of your examples. And we're ahead a little bit on time, so if you need to stretch a couple of minutes more, it's okay.
Perfect, and thank you. So I think, speaking from our experience, we've certainly seen, a good number of examples in the past few years that really have demonstrated that there are certainly segments of the global health landscape which are, genuinely investable. And I think, it's obviously quite a broad landscape. And I think what we've seen is, it has worked quite well, particularly in the case of global health commodities. We were pulled into structuring and fund managed for a period something called the Global Health Investment Fund, that was really a concept born out of the Bill and Melinda Gates Foundation, who then played a key role in providing a partial guarantee to the fund. But this was, quite a good example, I think, of how public and philanthropic money can come together with private sector to deliver, real results for the sector. The fund was designed to invest in mostly late stage R&D or commercialized, products that were close to commercialization in the global health sphere. And it was, it made money on a whole bunch of different investments. For example, a river blindness drug that generated a 10x return. Well, the big reason behind that return is because there was a very enabling policy environment as well. So I think, private investment can work, but it can't work necessarily in a vacuum. So the moxidectin example for river blindness was awarded a priority review voucher by the FDA, and that's really what generated the return for the fund, because the drug ideally will be given away free at a programmatic level. So it's really, I think it's the marrying of an investment model that is enabled by a policy environment there, I think is important to note. And I think another example from the GHIF was an investment in scaling up a cholera vaccine. Again, very much a kind of global health good, but the investment there again generated quite a good return, and that was really supported by signals from Gavi around their procurement intention. So I think, you do need the whole landscape to be working together, I think, for the investment model to work. But I think, it has been deemed a success. There will be a GHIF too, and there have been some other examples that have followed in the wake of that, and the Team Fund is one of them. I think what I would say is on the delivery side, when you start to think about investing in healthcare delivery, the picture does get a little bit more complicated. In part because it becomes a bit more of a macro play when you're investing in services on the ground. Definitionally, you're often also taking foreign currency risk as an investor, and also sort of general risk around growth of economy and people's ability to pay for healthcare. So I think that has been a bit more cyclical and tends to be challenging, and you also do get a bit more tension there, I think, around the dialogue between margins and prices, and a lot of the conversations there around the trade-off between access and equity and investor returns. I think there's been some really interesting kind of, I guess, opportunities coming out of COVID-19. One I would say is, a lot of investor interest around digital health and telemedicine. This was happening before COVID, but has really accelerated. So I think quite an interesting trend there, and there is quite a lot of capital floating around looking for opportunities there. And I think another one really to talk about quickly is the sort of themes around, and this is coming, I think, more from the donor side now, is around investing in manufacturing capabilities, in the global south. So looking at, the fragility of supply chains, I think has been a real feature of conversations this year. And I think a lot of organizations now thinking, how can we make systems more resilient? And part of that is bringing the production of commodities closer to the markets. And so, IFC announced a very big initiative around funding supply chain improvements and onshoring, etc. And I think that will continue to see quite a big trend from the donor side around that. And I think the private sector will, and already is actually responding. We're having a lot of interesting conversations around initiatives from the private sector around, vaccine manufacturing in Africa, for example. And just sort of very, very lastly, I think, there are some areas, we talk about global health, there are some issues that are genuinely global. And there, I think you sort of see a slightly different dynamic in terms of investment, because, you have topics like AMR and now COVID, where clearly you have very different pools of capital, and it's not just a sort of development question anymore. And so I think there's, been some really interesting collaborations that we've seen. I think AMR is a good example we can maybe talk about in the discussion, and COVID as well. And I think that's, a different kind of case again in the space of global health. But I will pause there. I think that's my 5 minutes.
Right. That's great, Victoria. Actually, because we have got a little bit of time in hand, could I maybe press you a little bit to on the question, and I'm going to ask the same of Prabhu in a minute, is, in the model that you've been investing in and involved in, do you feel that it delivers for, there's been a return on investment, and we've talked about some of the issues sometimes in being cyclical, etc. Do you feel that it's delivered against the, sustainable development goals, for the people that it's meant to deliver for, those initiatives?
I think, if you look at the case of GHIF, I think you can really, you can genuinely say, yes, it has. I think getting a new drug for river blindness approved, and this is something that had really been kind of mothballed in the development stages, is going to be really transformational in the fight against that disease. So yes, I think you can say that it has made a big difference. Clearly, I think when you think about commodities, getting products, through approval and to market is only one piece of the jigsaw, though, right? Because I think there's a lot of mechanics that also need to happen around that, in terms of then, funding needs to be in place for delivery, and the infrastructure needs to be in place for delivery. So I think the success of GHIF has certainly not been in a vacuum, and it's been dependent on there being programmatic initiatives around it to get these commodities actually out to the places they're needed.
Yeah, no, that's very
to
clear.
me, that's sort of a key lesson, really, is that investors really need to you need to really look at this whole picture holistically, because and we've done a lot in the commodity space. You really need to be thinking around kind of what is that actual path to this product getting to patients, because without that, you clearly sort of lose the impact story completely.
Right. That's excellent. Good. Well, I think thanks very much for being very succinct, Victoria. Let's stay in the same area of impact, finance firms, and move over to Prabhu just now. And just on the same theme, I'd like, as part of what you're saying to us, Prabhu, if you also touch on what I asked Victoria, and I suppose it's one of the early questions we had in the beginning, is considering whether the interest in impact investing could ever replace the need for the public sector financing, as an alternative sector, or is it simply a tool to make that more efficient? I think that's the sort of question we're all driving at, because that's one of the questions posed. Anyway, but anyway, I won't say more myself. Let's pass over to Prabhu, and then we'll have a question. Are you there?
Sorry, I was on mute. I was saying, just so I understand your question, you were wondering if the interest in impact capital could lead to adequate inflows that impact capital replaces or negates a need for public sector investment at all sometime in the future. Was that it?
Yes. Now I realize it's a silly
Yeah.
question as I said it, because of course it will never replace. But in other words, are
Yeah.
we actually ever generating new? What I mean is, are we generating additional sources of financing for the health sector, or just actually recycling sources that were already
Right.
there? This is a question.
Yeah. No, I think your question, I'll answer both parts to your question. The first one, of course, like you rightly said, it cannot replace. But what we see is impact capital is getting better and better at filling the gaps with respect to what public sector has been doing, like very specifically looking at areas of innovation, market making, and even in healthcare delivery, or reaching out to some of the far-flung areas, which even the public sector has been finding difficult to do, especially with the advent of health tech. So there's been a definite move towards that. To your second question on whether capital is being recycled, I'd definitely say there's a lot of additional capital that is coming in into the healthcare focused funds, as well as capital that is going downstream from healthcare focused funds into enterprises. So let me qualify both of them. With respect to upstream financing, we see that there are multiple new LPs, essentially funds to invest into our funds, who have been coming in. COVID's essentially proved to be a blessing, in fact, where we have just finished the close of our first fund a few months back at 65 million, and all of this happened remote. Of course, some of the discussion started before the beginning of the pandemic, but because of the interest in healthcare, we definitely had much more fruitful conversations with our LPs. And say the Indian government's biotech focused fund of funds, the Indian government's quasi-governmental fund as well have been investors. And we have one of our LPs as well in the room today with Mark here. So there has been a definite increase in newer forms of capital. And I'd say very smart investors like say pharma firms as well coming into the impact capital sector. So I think that way 2020 or say has been a definite turning point. In terms of downstream financing as well, what we look for is how whether we are not whether we are replacing traditional capital. Are we chasing the same deals that your traditional funds are doing? If so, we aren't really adding impact. So we really look at deals that are high risk, that traditional funds do not go after, so that we foster those companies and bring them to a stage where traditional funds could invest in them. So I'd say there's been a definite enlightenment towards both upstream and downstream financing, and definitely much more additionality. James, you're on mute. I'm just going to take the occasion before you unmute to speak about an example as well. So we've just closed yeah. Two investments, both of which I consider to be pretty innovative. One is in a telemedicine startup, which has been a past portfolio firm, but thanks to COVID, we are seeing a resurgence in the need for telemedicine. More importantly, much more openness from government bodies. So essentially, the pipeline has blown up with orders coming in from across India as well as Africa. So we're doing a follow-on investment in this highly impactful firm. The second is an investment into diagnostics, point of care diagnostics, which was the flavor of the season 6 months back and will continue to be, I guess. Uh, uh, this is a very innovative, say, firm that's looking at shortening uh, the time taken for diagnosis to 10 minutes and the cost down to a few dollars, but at the same time retaining the accuracy levels at 99%, which is equivalent to what traditional labs would do. So I guess both of these are pointers to the fact that there is real additionality coming from impact capital. On to you, James.
Great. No, that's all I was asking, is for those wonderful examples. So that's really good. So there's some common themes coming together here. Let's move on. I'm sort of going in a direction of private investment houses to. So we'll come to Naomi last, because that's now a development program and one of our own. So let's go to Mark next, moving to private sector, but in a different modality. It's private sector actually doing something itself rather than investing. So anyway, over to you.
Great, thanks, Max. Yeah, it's a little bit of a hybrid. So for those that are not familiar, Merck from Others is a $500 million initiative that was birthed out of Merck, the pharmaceutical company. And so we do come to maternal health and the global health issue from a private sector perspective. And one of our objectives is, obviously to bring the best of private expertise, innovation, but also to mobilize resources. Because if you've looked at all of the sort of costing in terms of what the financial implications it will take to actually achieve the SDGs, there's significant gaps. It's 3.1 trillion if you look at sort of the post-2015 SDG agenda. Within the maternal and child health space, which is where we're focused, it's been tabulated as around a $33 billion gap per year in terms of what it's going to need to get to the SDG targets by 2030. And recognizing that in order to be able to do that, it needs to have sort of this sort of multiplicity of different types of financing and bringing more private capital into the health sector. So Merck from Others sort of dipped its toe in innovative financing with a first development impact fund in India. And that got us to thinking about how we could deploy our grant capital a bit more creatively. We're a little unique in terms of a donor because we have a little bit more flexibility. And we do have a mandate in terms of being a little bit more experimental. And so that experience with the impact bond kind of led us to how can we deploy grant capital to really leverage and attract other private capital into the maternal health investment space in the countries that we're working in. And that birthed the initiative called the Moms Initiative, which is a consortium of partners, ourselves providing $5 million of grant capital in partnership with the Development Finance Corporation, which is the DFI arm of the federal government of the US. They have committed $45 million of debt financing. And then we also have a partnership. USAID is providing technical assistance, and Credit Suisse is also providing technical assistance. And so when we ventured into this partnership, originally the thought was, well, how do we want to structure this? And one idea was around, let's do like a special purpose vehicle, try to minimize the transaction cost. But then the DFC, and I think kind of rightly, was like, well, we don't know how this partnership is going to play out, and we don't know exactly what kind of deal flow we might see. And so let's just sort of, for this first sort of $50 million kind of commitment, let's be lean and just sort of see how things unfold. And to the question around what's working, I think it's been a really instructive and insightful partnership. I think the biggest areas that we have seen in terms of the different investments is one is that grant capital is, well, one, it's the most coveted of the capital stacks because it's essentially free money. And so one of the things is I think we need more grant capital to really unlock additional financing. But if you think about, if we're committing $5 million of our grant capital and can unlock $45 million of debt financing, that's a huge leverage point. And that's what and then we're achieving and helping closing those financing gaps within the global health space. But I think one of the things is initially we thought our grant capital would be blended with debt financing with each of our deals. But as we started having conversations with a lot of our sort of enterprises that we're vetting for the pipeline, their needs were different. Our first deal actually did represent kind of the classic blended financing model. LifeBank, which is a Nigerian-based organization that's medical distribution, primarily blood and oxygen, had been generating revenue. It was slightly below the threshold that DFC needed, which was $1 million in turnover, in order for them to provide the grant or the debt financing. So they needed our grant capital to de-risk that deal. Eventually, the deal likely would have happened. It probably would have happened in 2022, 2023, when LifeBank reached a certain level of maturity that the DFC likes to see in terms of some of these enterprises. So what our grant capital is able to do is just sort of accelerate that deal and make it happen more quickly. And it's been great because obviously one of their products is oxygen, which has been tremendously impactful in Nigeria based on the COVID pandemic response there. But then other opportunities that we're seeing hasn't necessarily played out in terms of that blended financing model. There's been a couple of enterprises that we've been looking at that they needed to do some due diligence first to strengthen their business case to take to DFC. So for example, one enterprise is looking at, do they vertically integrate or do they partner and refer out in terms of their delivery model in maternal health? And so they wanted to do a study to rationalize, referral versus sort of build those internal capabilities. So we're funding that, which will then help inform their broader business case and their pitch to the DFC for a debt financing. There's another example where we're testing a blended financing model with a primary care clinics in South Africa to figure out what is the right mix of grant capital versus debt financing that will then allow DFC to come in with that validated model in a much bigger way than they probably would have traditionally done. So I think some of the things that we're finding is that by having that flexibility and really providing the capital that the enterprise needs in order to unlock additional larger sums of money, whether that be in debt or equity, we've proven that flexibility is really tremendous. The other thing that I think what's working is there's a lot of enterprises and innovation that's happening locally. So social entrepreneurs in these markets have figured out what are the market failures and really solved for that and done that in a very sustainable and a very low cost way. And so one of the nice things about sort of this partnership with Moms Initiative is all of these enterprises, particularly if they actually go through the vetting process and the due diligence that the DFC provides, are sustainable, viable business models, delivering on impact, on that health impact, and helping to strengthen those health systems in the markets that we're focused on. So we see that this investment also not only drives the impact, but also allows for that sustainability, which is often a challenge in the development sector. And then I think the other point that we're seeing also is a lot of these enterprises have a sort of a digital underpinning. They have been incubated out of a very strong technology platform that allows for transparency, allows for the ability to measure what they're doing, the ability for them to really understand how they're operating in a very efficient way. And that I think is really critical, not only for the financial viability of the model, but also in order to be able to sort of articulate what the impact is that they're delivering. And so COVID, I think also, to Victoria's point earlier, has also just accelerated that need for that sort of digital enablement. And I think that will also help in terms of attracting more capital, because I think part of the sort of perceived risk, particularly when deploying both debt and equity capital, is that lack of transparency. And I think the technology really allows for a lot more transparency and really understanding how the business is operating and being able to quickly derive some of those financial benchmarks that are needed to give the peace of mind to the underwriters that this is a viable and investable business. So those are some of the things just through the lens of the Moms Initiative that we're seeing that I think are working really well. Over to you.
Great, that was really interesting. So I just wanted to ask a quick question, is just thinking about this whole theme about, is it working, before we come on to Noemi just now, is do you ever have a profile on who the customers are of the businesses that you invest in? In other words, that's answering the, the equity SDG question that we're always asked to answer, thinking about this from a broader perspective.
Yeah, I would say when we're looking at the maternal health lens, we had sort of a pipeline that we developed, and then USAID also had a pipeline, and there was a lot of overlap, which to say is that there's, I think pipeline is a challenge, and some of the ones that have emerged are sort of the market darlings and the unicorns, where everyone's sort of piling on and providing kind of technical assistance and capital. I think part of the issue has been that a lot of the innovations and a lot of the sort of programs have also been funded by donors. And I think that's been a little bit at the detriment in terms of their ability and capacity to really shift their mindset around how to make this much more investable and much more sustainable. And so part of our grant capital is really to try to help get them that capacity, particularly on the financial and business model piece of it, because donor money is somewhat arguably easier to get. There's no sort of strings attached, although delivery in terms of on the impact side. On the equity piece, I think that's also an interesting, scenario. All of the investments that we're looking at are ticking the box from others' point of view in terms of equity. Life Bank, for example, are servicing both private clinics and hospitals as well as public. But they've done a really savvy job at sort of segmenting those hospitals and charging different prices based on their capacity to pay. And then they also have generated a foundation where if they are delivering blood and the patient or the hospital can't pay, that will get subsidized and will be pulled out of the foundation. So they're figuring out different ways of maintaining impact, but also kind of preserving their sustainable business model so that can continue to scale and to grow.
Great, that's excellent. Great, good. Well, let's move on to Noemi now. And now we're sort of graduating through the different styles, and now we'll come to a major donor program.
Yeah, thanks, Mac, and thanks everyone. Maybe before I go into some of the examples of the work we're doing on the ground, it would be helpful to explain a little bit about how the Invest project works. And as Mac said, this is implemented by DAI, which is a company that's been working as a USAID implementer for quite some time. So Mac, one of the comments you made early on was about PSE, private sector engagement, and what exactly does that mean? And the Invest project is a result of that strategy of USAID. So that intentional strategy to see how can we do things differently? How can we kind of disrupt, if you will, development and bring in new partners, such as COIS, as Lion's Head, as Merck for Mothers, and others who haven't traditionally moved in the development sphere. And part of that is, we have these goals, we're trying to reach the SDGs, but what we've done for decades now in development isn't quite working. So let's take another tact. Let's engage firms that typically have not worked with USAID, and so are both themselves new to working with donor funds, USG funds in particular, but also firms who don't move in that donor sphere. So why that? Like, why this approach? I think my colleagues here who've spoken about it, but Lion's Head, Merck, and COIS, they've explained why. I think there's definitely there's different expertise that comes in and a different viewpoint, because what we've seen is the private sector is, they're risk averse. They're not going to invest in something that doesn't have some sort of return. And so when we talk about sustainability, we're looking for some return. And traditionally with the private sector, that return is going to be financial, right? But on top of that, we're also layering with impact investing, development returns, outcomes that contribute to greater social goods. So with Invest, how we operate is, we are a buy-in mechanism, which means that different USAID missions, so let's say a Vietnam or even units like Global Health, they buy in. So we have a ceiling of 167 million, and depending on what the particular needs are. So I have in my portfolio a couple of buy-ins where there is a health focus. So Vietnam, very local, looking at how CBOs and social enterprises can become financially sustainable, especially as PEPFAR funding is going down. And then a $10 million program in Italy to help support businesses engaged in the manufacture, development, and supply of PPE and other medical needs for COVID response. And that's something that I'll go into a bit later. But what we've seen is, via the sorts of mechanisms that Mark had mentioned, how can you take philanthropic or donor funding and basically de-risk it? So encourage capital, private capital or DFI capital to come in. To date, since our 3 years, on Invest, we've mobilized an additional 172 million. So it's worked. I mean, I think USAID's hypothesis that we can leverage additional funding by using USAID funding to again, de-risk and have that concessionary role has in 3 years mobilized an additional 172 million. And we're tracking this very closely because it is one of the indicators that USAID is looking for. How much capital are we mobilizing? What kind of additionality are we bringing in? But by the time our project ends in September 2022, we will have mobilized an additional 1.6 billion in additional capital. So I think the model is working. I don't believe, as you mentioned, is this the end all? No, we are talking that there has to be some combination of public finance. There are public goods. We're talking about health. But you can definitely bring in other players who are looking to invest both for financial returns, but also because they are impact investors, because they are looking for social returns as well. I would say many of our partners, and we have over 100 partners that are currently helping us implement this program, and that continues to grow. We tap into a finance and investment network that Invest manages, that is of USAID's, that we can pull into that expertise needed for particular transactions. So I think there's some great, there's some great work being done with this approach. 10 years ago, even 20 years ago, I wouldn't, and I've been developing for a while, we wouldn't have been working with the Lions Heads of the world. So it's great to see that, that this disruption, this bringing in new private sector players with a different approach and a different way of thinking has brought about, I think, another look at what we mean by sustainability, in particular financial sustainability of development initiatives. And I'll stop there.
Excellent, Noemi, that was wonderful. I think I've got to keep us moving to the next topic because otherwise I'll be in trouble for being a bad moderator in the interest of time. But we'll have time in the final segment to ask lots of questions and more discussion. So that was all wonderful from all those panelists. And now let's move to the second topic, which is all about return on investment. And as we said on the in our notes, what does it mean to whom and why? In other words, how do you measure that? Is it financial? If it's social impact, social return, then what are we talking about here? Those are the questions. And then, in some summary, we are looking at topics like what does good sustainable financing mean? Social good sustainably financed. That's a term we hear a lot. Let's try and describe that and pull out some examples and sort of kick the tires a bit to see whether it's a robust enough definition that's commonly used. And yeah, just considering all these issues, and particularly, coming back to what, I think is our central question is, are we reaching the market segments that wouldn't have been already reached by the private sector, let's say, anyway, because that really is a measure of social good. So I think these are the sorts of measurements and considerations that this session is about. So I think let's go again, because our wonderful panelists have some examples and have given us some pre-thought. So they promise. No, we have. And so let's go in the same order again. And who did we start with last time? We started with
It was me.
Yeah, we did, didn't we? So maybe Victoria can tell us what everything you think about return on investment and measurement.
Yeah, I mean, so I think in terms of the financial returns, I mean, in some senses that's the easy part, right? It's sort of it's readily kind of quantifiable, and so I think it's really when we're talking about this, it's around how do we measure the impact piece. And I think that there are a few challenges around this, and I'm not sure I have easy answers, but maybe I can talk through kind of some of the ways that we have thought about it and some of the challenges that we see come up time and time again. I mean, I think there's number one is just clearly kind of measuring, well, defining impact is the first challenge, right? And kind of what do you really mean? And as you rightly point out, Matt, kind of, you know, making sure you're capturing not just sort of the right activities and outputs, but also making sure those are benefiting the right segments of the population that are most in need. I think, you know, there has obviously been a huge industry that has developed around monitoring and evaluation, which is really, really important from a programmatic perspective. But I think as you start to kind of see that become more and more closely linked with financial returns, I think there is a bit of a, you know, there's a careful balancing act, I guess, around how much you spend on designing and then monitoring these impact measures versus what could have been spent on programmatic activities. And I think, you know, I think DIBs are a really good example of this, where, you know, I think conceptually it's, you know, it's a really great idea, but without scale, they become really, really expensive because so much money gets spent on the piece around really defining kind of what are the outcomes and how will payments be linked to those outcomes. You know, you can spend easily sort of $1 million on a, you know, $5-6 million DIB just trying to answer that question. So I think kind of there is a need to try and kind of streamline, I guess, some of the debate around how to measure impact and to try and align on some of these things. And I think it's not a problem that has yet been fully cracked by kind of the development and the investment community collectively. I think, I mean, another one of the challenges is that you do see that, you know, some interventions in healthcare lend themselves much more readily to measurement than others do in terms of the impact. And I think, you know, the cataract dip is a nice example of that in one sense. You know, it's quite a sort of, it's quite a neat intervention, and one cataract operation generally leads to restored vision. And, you know, there's quite a linear relationship there. Looking at, for example, some of the DIBs that people have tried to, or, you know, in the process of trying to set up in the wash sector, I think it becomes a lot more difficult to really link the intervention to the wider impact. And if you're thinking around, you know, access to a toilet and the impact on reduction, for example, in diarrheal disease might mean improved school attendance or work attendance, etc. It becomes a lot more difficult to try and capture those. So I think there is a bit of a danger that some of the sort of the impact investments gravitate towards those areas that are readily measurable, rather than the areas that most need kind of new or innovative sources of capital. You know, I think obviously there is good work going on this. I think USAID actually had funded the measure evaluation project. They've built a big compendium of results-based financing indicators in healthcare. So I think, you know, there are efforts to try and kind of centralize some of this knowledge. But I think, you know, I guess my final message around kind of this defining the impact piece is that there is a role for innovation, but it is a tool rather than a solution in itself. And so I think there will always be a role for, you know, for pure donor capital. And I think on that note, I mean, we do see, I think there's an interesting trend actually, and I think around the risk that donors are willing to take actually, and donors are really increasingly kind of, you know, thinking around wanting to make sure they're funding successful programs. I mean, rightly so. But it's interesting actually, Mark talking about Merck for Mothers actually, so the private sector taking some of that kind of initial risk in terms of demonstration effect to try and then crowd in donor money on top of it. So I think that's a very interesting sort of about, you know, sort of almost an about turn in terms of how you would imagine the world to be. And I think that kind of risk averseness in the donor landscape is, you know, is challenging, but we're seeing it more and more, I think, around donors, not just investors, but donors themselves wanting to tie funding to impact. Oh, I think you might be muted still, Matt, or for me anyway.
I always do that. I'll keep us moving in the spirit of time. That was great, Victoria. Thank you. We'll come back in a second. So Prabhu, it's your turn next. Tell us all about measurement of impact and your experience.
Yeah. So I'll take the second question first and move forward. So like Victoria mentioned, you could put, say, different layers of measuring impact, and I guess there's a complete industry around measuring impact. What we look at is when we think of impact in two stages. One is when it comes as an investment to you. That's rather the more difficult part, really separating the impactful ones from the ones that maybe could be impact, or the ones that maybe could be packaged as impact, because there's a huge sector called impact washing, which has been doing the rounds over the past few years as well. So that's really the toughest part in this impact journey. It's not really the measurement, because there are adequate processes, frameworks. We have personnel, including ESG for ESG and so on, to measure our portfolio on an ongoing basis. What we do find difficult and constantly question ourselves is, what is impact when it comes to healthcare, and how do you measure it? And thankfully, we have a set of processes, say, that facilitate this. So at every screening committee, we do look at whether this passes a sniff test, versus impactful or not. And our LPs as well play a key role, and each investment has to pass through them as to whether this is impactful or not, and go ahead. So we wouldn't really invest in a hospital in the heartland of Delhi, which caters to the top 5% of India. We would really want to go out into Uttar Pradesh and invest in a hospital that delivers care more to the bottom of the pyramid and the middle income populations. So that's one example. But really, the toughest ones to say no to are the investments that are financially great but lie on the impact borderline. So that's a philosophical question that we ask ourselves every time we do an investment or not. When speaking about the first question about how do you make it sustainably financed, that once again is an ongoing operation, and it changes with respect to each company that we go into. Similar to what Mark mentioned, you can't really say, I'm going to look at only impact and go to the bottom of the pyramid and not really cater to any other demographic, because then you're really cornering yourself and not creating a sustainable model. If it so happens that there is a sustainable model catering to bottom of the pyramid, we do go ahead with that and have plenty of examples. Say the telemedicine company that I mentioned is purely almost funded through government and public sector and CSR funds. But it does lead to problems where there are, say, much more prolonged working capital cycles, because your payments come in late, the margins are thinner, and so on. So you really want to diversify your portfolio when it comes to sales. So that's where we see that every one of a startup caters to the private sector, but also the public sector, and essentially look at cross-subsidization models. You look at different demographics, geographies, and pricing models as well, so that you deliver impact, but at the same time create a financially sustainable model. Just taking an example of our a portfolio firm from our first fund, and we invested in it once again during COVID, is into medical supplies. And so during the beginning of the pandemic, we were essentially juggling orders between the private sector, which really wanted to cater to its patients, as opposed to the government hospitals, which were looking at catering to the COVID-19 patients. And that's where you really take a call about what is it that you want to do. Am I going to cater to just the private sector, which is going to pay me upfront? Or am I going to take the risk of procuring PPE from China and passing it on to the public sector and wait for slightly delayed payment cycles and lower prices? And thankfully, we successfully managed to do that. And the firm is going from strength to strength with more and more government orders coming in. I think that's a case of just sustainably financing by working across demographics and buyers.
Great. Thank you so much, Prabhu. We're running over a little bit on time, so I'm being chivied. So we'll come back, but I will move on to Mark. Could I ask you to be succinct? Sorry, Mark, and Naomi have left.
No, I'll just nuance a little bit in terms of how Merck from Others is looking at the return on investment. I think One was just, how can we attract more private capital into the health sector, particularly in maternal health? So that's one of the ways that we look at, and that multiplier in terms of our 5 million of grant capital, if we're successfully mobilizing 45 million, and Naomi mentioned some of that multiplier and that leverage, that is something that we look at. I think also what's very becoming much more apparent is just stimulating entrepreneurship in health. And I think at the local level, we have found there's just a tremendous amount of inspiring innovation that's happening in the health sector locally. And there's just not the right sort of financing structures to support that. And I would arguably say that a lot of the development has sometimes crowded or co-opted some of that innovation and those opportunities. So for us, it's all around sort of social entrepreneurs at the local level. That's another sort of metric that we're trying to identify. The other interesting element as well is just through conversations, just getting a much better sense in terms of insights, in terms of cost of care and different delivery models. That is happening. And when you have these different conversations and due diligence, you start to really understand what that looks like, and where there's some efficiencies and inefficiencies in some of these investable opportunities that are addressing. And then I think the one thing that I would underscore, and what's becoming increasingly more important, not only from others, but I think more broadly, is on that level of impact, the beneficiary impact. And making sure that we have a mechanism in place to be able to really understand those that we're trying to reach, the beneficiaries of these investments. Are we making an impact, and are we doing good? And there's different models out there in a very lean way of being able to sort of pulse if you are succeeding. And so I think we're trying to inoculate that sort of system in our MOMS initiative, looking at ways of doing lean data to get understand the beneficiaries, and if we're actually moving the needle in that regard.
Excellent, Mark. Thank you so much. Going to move right on to Noemi in a few minutes, please.
Sure. So in broad terms on Invest, we're looking at what are the, what are we measuring? So at the top line level, because we have this collection of buy-ins, it varies from a Vietnam to an Indonesia to, to countries in Africa. But what we're looking at is additionality. So how is USAID funding being used, being leveraged to be able to mobilize additional investments? Example, in the Italy buy-in, we have two approaches that we're taking. One approach is catalytic capital. So how can we use USAID funding to help mobilize more capital, both from DFIs in Europe, but also with private investors. And we're achieving about a 10-time leverage on what is being used from USAID's funding to additional capital coming in. So that's something that we're measuring is that additionality. The other thing is, how are we supporting broader economic resilience? Again, this is the Italy case, wherein USAID is supporting how can they ramp up manufacturing, how can companies retool. And many of these companies are SMEs, they're family owned, they're small businesses that were impacted by COVID. But now through the support, through technical assistance, in some cases funding and additional investments, they are ramping up and increasing their production. So they're meeting the health needs of additional supplies for the expected second wave that is now unfortunately hitting in Italy. Or in some cases, the group of manufacturers we're helping to support are increasing the local supply by about 12%. So, there is an impact. There is an expectation that through this, they'll be able to provide equipment supplies that were missing or that weren't available when that first wave hit. But I think, the other thing that we're trying to do too in capturing, and we're capturing that through the work that our partners, such as the other panelists are supporting Invest in, is the innovation and learning. And how do we then incorporate that learning? How do we demonstrate, for example, Merck from Others is kind of the ideal sort of initiative that resonates with the purpose of Invest. Where you are creating a capital stack where you have companies who are both investing, perhaps their grant funding, but that's just a piece of it. They're looking how they can identify more commercially viable approaches and investments. So that success is, the impact we're having is, or we hope to have is, not to substitute, but Mark said it in the beginning, like, would it have happened? Yes. Perhaps eventually. Is it happening faster? Meaning, are there going to be positive results that will come from this at that community level sooner than they would have, whether it's lives saved or those receiving treatment, what have you, and to be able to say, yes, that impact has happened because we have catalyzed additional investments. We have de-risked it so others can come in and say, yes, we want to speed things up. So those are some of the things we're trying to capture on Invest, both at that top line, but also at that local level, businesses supported, SME supported, additional capital coming in, and so on.
Great, fantastic. So just in the interest of time, now we're going to move on to the wrap-up session, which we wanted to have final thoughts from everybody, and if possible, allow time for some questions. But so let's do it in this order. Let's do the final wrap-up from each of our panelists, and perhaps if I say my own little wrap-up first, which is, I think this has been a fantastic session. I think some of the key takeaways that I think common themes from all of our speakers is that they are very, I will start with just very few points. That it's very simple. There are various things that can be measured to know whether this is worth the effort, basically. And that is, of course, in the social impact, as well as the return on investment. And there are some softer externalities, if you like, which aren't obvious, which fall outside of those. And that, to me, listening to all of you, is the greater efficiencies, which leads to sustainability in some of the business models and some of the innovations and some of the businesses that are delivering innovations that are invested in because of the discipline of the fund, private financing, blended finance, all of this. That's one takeaway I'm hearing. The other is, of course, it's always a balance, as we've always known, between, what does financial sustainability mean, and also reaching only the base of the pyramid. There has to be some mixed model, obviously, for viability. And then the other issue was that knowledge, of course, is that it's easy to overlook the lessons, the learning, which is related to the efficiencies, but also technological and business model learning that comes out of this kind of financing, which, in the run of the mill. In other words, innovation and learning is better served, which has a social impact, which doesn't fit into the normal measures. Anyway, that was my summary. But now let's go around in order to our wonderful panelists. Victoria first, please.
Thanks. I mean, I think, my takeaway from this, I think we can all be really encouraged by the fact that actually a lot of really good things are happening in the space in terms of crowding private sector money in a meaningful way. There's a whole host of initiatives, I think, and I think Merck from Others is a really good one, but there's plenty of others too, where we have seen the pharma sector in particular really step up and get involved in some really innovative initiatives. And equally, I think as we've seen from Noemi on the donor side, I think donors are kind of much more comfortable with the idea of private sector playing a role than I think they were a few years back. And I think there's still a really important role for donors to play, I think, in catalyzing the private sector at times. I think we see, we laugh at Lions Head sometimes, that there's far more people out there who would love our advice on how to kind of get development projects going than can ever pay for it. And I think so donors can help with these kind of questions around funding this, the feasibility, is this going to work, and to really kind of de-risk the decision-making a bit for the private sector. So, I think lots of great examples, and good to see the two sides working.
Yes.
One big insight for me was just the variety of toolkit that we saw today. We're starting with the world's biggest donor all the way to, say, an equity fund and foundations and the rest in the middle. So 15, 20 years back, these would have existed as very separate buckets, wherein there was philanthropic capital and there was, say, private sector capital. But within the short time span, we've really managed to fill the gap starting from both sides. And like Naomi mentioned, there's been immense validation as well of these models already.
Great. And Mark.
Yeah, so I will qualify mine's a bit of a personalized editorial. I think one of the things that gets me excited, but also frustrated, is that there's a lot of investable opportunity, particularly in LMIC countries, but yet the sphere of influence, London and New York, and even in Silicon Valley, there's tons of capital out there, and it's going to what I think are marginally inferior investable opportunities. I mean, if you look at the venture capital investments, they're happy if they get 1 out of 9 successes. And so I think the more that we can demonstrate different models, the more that we can show the innovation, I think the better. And I think, you know, my ask is that we have more grant capital, more private capital, and really kind of help accelerate what I think is investable health systems in sub-Saharan Africa. And I think you also just look at COVID, the cost to the global economy is measured in trillions of dollars. With just a modicum of that investment in the public health space, you can see the benefit that would have just in terms of economic principle. So I think we're at this sort of inflection point where we can get the attention of investors, as well as the importance, and in my case, the bias of health, to really drive some of these partnerships and accelerate them in a much more aggressive way.
Excellent. And Noemi.
Yeah, I'm really heartened by the shift that development has taken in terms of engaging the private sector, and particularly the finance investment side. You know, I think it's a positive step. What I want to caution, though, is it isn't the solution. No, it's not going to replace good government policy. You know, it's not going to replace the role of NGOs and others who are working at that very localized level. So I think what we need to move towards is that balance, you know, that balance of where does it make most sense for the private sector, and we're saying that broadly, but in particular the finance investment side. What role can they play? How does that complement enabling environment, you know, the policy side? And then if we want to look at the local side, you know, civil society, what is the role they play in that? The other thing, and it's a bit echoing what Mark is saying, or maybe taking a little bit different, is how can we ensure that solutions are localized and that it's meeting local needs? Because oftentimes what we're seeing with our investors, or you know, the investment firms we're working with, they're looking at bigger ticket sizes. And yet at that very, you know, local community level, and we're seeing this with the work we're doing in Vietnam, it's not going to be a huge return on investment in financial terms. You know, we're working with CBOs, social enterprises, but the idea is that they can then continue to provide support and services to their key populations who otherwise would not be able to afford services. Or how can we also ensure that we are supporting the development of local investment initiatives? So one example, and this isn't health, is, you know, we're supporting a women's investment club in Senegal. And, you know, these are women from Senegal and the Ivory Coast who are then investing in businesses in their countries. And so they have more than just, you know, the return on investment goes far beyond just the financial return, but there's also that, how can we support our countries? How can we grow other women owned and led businesses, but also contribute to development of the countries and you know, where they live and work. So those are things I think engaging the private sector is important, but let's keep local also very much in mind as we're helping to mobilize additional investments into health and to other sectors as well.
Great, fabulous, fabulous. So now I think in the remaining few minutes, we can field any questions that participants have for any of the panelists they want to ask. And we ask that they send them through the chat. So shall I read them out? There's one for Mark. All right.
I can pick up the first one.
Okay.
the pain points in structuring and implementing investments for health.
Okay, great.
I think pretty quickly, there are two major pain points that we see. One is essentially managing the cash flows or planning for payments, especially because you're working with the bottom of the pyramid, which means the government tends to be a big payer. This is something we can anticipate and plan against. The second is around regulatory hurdles or regulatory changes with respect to our business models. For example, suddenly there's a change in telemedicine data or the way in which your data is stored, or price controls that kick in after you made an investment in a hospital, which is something we can't plan against. I'd say we've gotten smarter at anticipating and handling both of these. With respect to one, we've realized that you will really have to structure your investment in that it can't be just pure equity because you need to plan for longer working capital cycles and really bring in working capital debt along with your equity in order to help these startups scale. And secondly, also plan for longer investment periods and follow-on investments, essentially to help them find that market fit and get to revenues, which typically takes longer as opposed to other segments.
Great, excellent. And I think we've got 3 minutes remaining before we turn into a pumpkin. So we'll take one more. Should it be for, I can see there's one for Mark and one for Victoria. In the interest of gender balance, let's get the question for Victoria.
Well, I think it sort of wraps into the first question too. I mean, I think, in terms of, what does it take to understand what donors looking for in terms of ROI? I think, it can be really varied, and that also goes back to the pain points on structuring. We see sometimes on structuring, getting different investors' expectations aligned and figuring out the risk tranche can be quite difficult, but equally sort of some of the private sector investors who you might think had different return expectations can really surprise you sometimes. And we had a really interesting example with AMR where we were trying to get a fund up and running with a slug of government money at the bottom, and actually industry said, well, actually we don't want a return on this, because if we demonstrate a return, because government will think we can make money out of this. So I think actually really, for me, the critical thing is really sort of trying to drill down of what all the various stakeholders want to get out of it. And I think in particular, kind of understanding that public-private dynamic and interaction, and sometimes the skepticism between the two parties can be really critical into sort of determining what expectations really are and how you marry that all together in an investment vehicle.
Wonderful. Great. So I think we have 30 seconds remaining, so we won't be allowed, the co-host will tell us all off. So it all remains for me to thank the marvelous panelists and everyone who participated. I've certainly found it really interesting, and I thank you all, and I hope you did too.
Thanks, everyone. Thank you.
Thanks, everybody.
Thanks, everyone.
Thank you, everyone.
Thank you. Oh, Annie, you've appeared. Okay, right. I guess we leave now. Thanks. Bye.